Hello, everyone. Very good evening, and welcome to today's evening session. Um, Let us first review about Ethereum before we uh, get into some of the topics which are very important for trading. So, Ethereum broke one important consolidation lower level. Once that level broke, there has been a good amount of selling since yesterday. There's a nice consolidation, and even the consolidation broke at the lower level, and Ethereum tested 2160 strike price today. So right now it is again in a consolidation phase with a good sellout since yesterday. This could be mainly due to the weekend impact, because weekend whenever weekend is nearing, the traders who have taken long positions, there is a possibility that they start booking profits, close their positions, so that they can take the benefit of their position at a higher level, because we never know what happens in the 2 days in a weekend, Saturday, Sunday. Uh, so probably the guys who doesn't trade on Saturday and Sundays, they set up their positions in weekdays, and once there is a good profitability areas, they start booking their profits, close their positions in the weekend, take a break from trading in weekends, and once the major markets open on Monday, they again resume their trading activities. So even uh, such cases are such cases impact uh, the market on weekends, low volumes. So there could be position closings happening that will drive the price towards lower levels. This also helps in one way to grab the liquidity which is available in the lower levels, and it will help major markets to create strategic positions at lower levels of liquidity, so that whenever there is uh, a good opportunity at a lower price, they will try to maximize their positions at a discounted levels, and then push the price upwards to maximize their profits at higher levels. So this is what usually happens. So that being said, let's discuss one important aspect that is very important in trading, whether you are a positional trader or an intraday trader or a scalper or an investor. So one thing is very important in the market that you need to clearly understand before you are venturing into the market, and that aspect is liquidity. So let us have some discussion over the concept of liquidity. We will try to understand what is liquidity in general terms. I'll try to keep it simple, right? So you might have heard this word a million times whenever you are observing the stock market or any economic news channel or uh, any financial organization. You might have heard this word, liquidity, liquidation, liquefied, liquid assets, all these terminology. So what exactly is liquidity? Liquidity is the fuel for the market. Whenever you see market moving from one strategic area to another strategic area, that is mainly due to the liquidity. So for example, you are a new trader. You you have recently opened your account, and you want to trade in any of the segments, either in indices or futures, or you are planning to invest in stocks, whatever may be the case. Obviously, you would be taking a position. You would be entering the market at a certain level, at a certain position, at a certain time, at a certain price. Now, most traders, whenever they are trading intraday, they place market orders. Some traders, they place limit orders. What are the order types? How orders work in the market? I will try to cover that concept in different videos. For now, our entire focus would be on liquidity and its impact in the intraday or positional or swing trading, or whatever type of trading you generally know. So this is fundamental to the market. The concept of liquidity is fundamental to the market. So whenever a trader is trying to take up a position or is trying to buy something, when he's placing a buy order, there should be a seller on the other side who is ready to sell that position at that price at that time on that day, so that this buy order gets filled. So a buy order gets mapped with a sell order, and the order is set to be executed. The order is set to be executed. That means this order has found liquidity in the market. A buyer was trying to enter, whether it is a market price or at a limited price. That is a different aspect. But whenever a trader is trying to enter and is placing an order, that order getting filled is due to liquidity. In a similar manner, whenever there is a seller who is trying to exit the market, suppose there is a seller at certain level, whether he is in profit or in loss, that, that's a different discussion. But if a seller wants to exit his position, or a buyer wants to exit his position, they should find the opposite party, either it is a buyer or a seller, to trade with them, so that the positions get filled and orders get executed. What is market? Market is nothing but a place where orders are getting executed as and when they are received. Of course, it depends on the market timings. So markets like crypto, which runs 24/7, every minute orders are coming in. There are sell orders coming in, there are buy orders coming in. And what is market doing fundamentally? Market is just mapping those orders. It is mapping buy orders with sell orders, and sell orders with buy orders, and it is fulfilling the orders. So for an individual trader, it is not a big issue to take a position. So whenever you want to execute, whenever you want to buy 1 or 2 Ethereum, you can just select 2 Ethereum and the price, it shows you the price and you click execute and your order gets executed. But what if there is a big financial institution, a very big financial institution, which is planning to buy 5 million Ethereum, or which is planning to buy 5 million, which is planning to sell 5 million Ethereums. If it suddenly places 5 million buy orders, market would skyrocket. Within no time, market would skyrocket and it would create a huge imbalance in the market, which is not favorable for a daily market operations. So what these big institutions plan is, they need to fill 5 million buy orders and they will select a range of price. For example, he want to, so there is a huge market financial institution which wants to buy 5 million Ethereum at a price range of 2200 and 21,180. He want to buy in this area, he want to buy 5 million Ethereum. So without disturbing the price, without creating any volatility in the price, it has to first accumulate it has to first accumulate positions within a range, so market becomes range bound for most of the times. So when market is playing in the range, some are buying and some are selling, the institution which wants to buy, it slowly starts adding its positions within that range, slowly filling up its positions, seeing that other market players as well enter market at the same position, and they start buying the positions. So for example, this is such area, for example. So market starts playing within a range, and everyone, all the financial institutions starts filling up its position silently, placing small orders, and it may take some hours or days, and by looking this, even retail traders and other small time traders, even they start taking up positions, and they start buying it. So the financial institutions, when others are buying, the financial institutions selling them start selling them. So once 5 million orders are accumulated, because the requirement was around 5 million, once the orders are accumulated, there is a high probability that they will manipulate the price to go down from that range. Most of the times they try to manipulate the market, bringing down the price, making other buyers who have already taken positions in those areas, and make them forcefully sell those positions at a very less price. So once manipulation is done, once the financial institutions fills up all its required, for example in this case 5 million orders, then price will shoot up, because the org or the financial institution has taken up an optimum position in the market at a lower discounted prices. Obviously, they will ensure that price shoots up to higher levels of availability or liquidity, so where they can sell. So in this case, when they are filling up 5 million orders, they are creating liquidity. That is what is the concept of liquidity. They are generating enough liquidity pool so that they can fit in their orders properly, and then most of the cases they would manipulate the price to a lower price, so that if any if there are any weak buyers, they would shake off the positions. Even those positions can be captured at a discounted price, and then the market will make its actual movement. So this is what usually happens. So there are three phases. Could be accumulation, where positions are accumulated, and manipulation, and as needed there could be a expansion. Then there could be, after manipulation, there could be an expansion to higher levels to sell those accumulated positions at a premium price. I'm not saying that is going to happen in this case right now here in Ethereum. I'm just giving an example to make you guys understand what is liquidity. So this is how liquidity works in the market. In the same thing happens when a big player is trying to sell 5 million positions. He would first try to capture positions, premium positions at higher levels, filling his orders at optimum price ranges, then manipulate it most of the times, and then bring down the prices so that he will have maximum profits for his sell positions. That is the usual scenarios. So in generic terms, they call it as AMD, which stands for accumulation, manipulation, and distribution in these generic terms. This is how liquidity is generated, manipulated, and then liquidity is distributed. So that is a concept of what is liquidity. Where is liquidity? When there is a question of where is liquidity, liquidity is everywhere in the market. Whenever you try to click a buy order, your order gets executed. Whenever you click a sell order, the order gets executed without any delay, because for every buy order there is a seller ready most of the times, and for every sell order there is a buyer ready most of the times. But for big organizations, for market makers or high net worth individuals, whenever they are trying to enter the market, their liquidity requirement is huge. So they will engineer the liquidity according to their requirement, manipulate it, and then manipulate it and optimally place their positions, and then make their moves in their desired directions. So this is how liquidity works in the market. So I will mark this video as part 1 of liquidity, and whenever there is a discussion or an explanation which can be added regarding the liquidity, I will be making another part 2 video of liquidity for our generic understanding. Till then, Thank you for watching today's video and have a wonderful weekend ahead. Thank you so much.